Alright, hey guys, we're going to go through the discussion on bad debt today, and this is the same discussion I'd give you if you came into the TA lab and was wondering what on earth is going on with accounts receivable and this allowance account. We're just going to go through all the steps today. So first of all, every time I approach these problems, I start out with my two T accounts. The first one is accounts receivable, and the second one is my allowance for bad debt. Don't get confused about this one. It's called allowance for bad debt, allowance for doubtful accounts. The key word here is the allowance. So it's dealing with the debts that have gone bad to us. And we'll talk a little bit more about that. So I want you to pause and think about what types of accounts are these? Are they assets? Are they liabilities? Are they owner's equity? What are they? So pause and think about it and then come back. Alright, so the accounts receivable is not new, right? It's an asset. So it goes up with a debit and down with a credit. The allowance account is the new one, and that's what we call a contra asset. All contra means is it goes against. So it's still a type of asset, but instead of having a debit balance, it has a credit balance. So it goes up with the credit and down with the debit. Alright? So because accounts receivable has a natural debit, it'll begin on the debit side, and because allowance has a natural credit, it'll begin on the credit side. Alright? So I want you to pause and think about what will make accounts receivable go up. What makes us show that more people owe us money? Well, one of those things is credit sales, right? So some people ask, what is credit sales? All credit sales is sales that aren't cash sales. So someone can come into our company and they can buy something from us and they can either pay cash for it right now or they can say, hey, I'm going to pay you later, right? That hey, I'm going to pay you later is when we record the accounts receivable, and that's what our credit sales is. So sometimes it should give you total sales and then say, oh, a percentage of this total sales is credit sales. So I just want you to remember that this number is not total sales. Credit sales plus cash sales is total sales. So if she gives you total sales, you need to multiply it by that percentage she says is credit sales and then put that number here. Okay? So just remember that. Now, I want you to pause and think about what are the things that will decrease my accounts receivable? What makes me show that people owe me less money? Alright, one of those things is cash collections. Okay, so when someone says, I'm going to pay you later, and then they do pay us later, we're going to decrease our accounts receivable, right? Another item that will decrease it is something called write-offs. And write-offs also go over here. So let's talk about what write-offs are. Before we do that, just remember there will be an ending balance on this side since it's a natural debit. Okay? Alright, so what are write-offs? These are actual numbers. This means we know for sure someone won't pay us back. So what does this journal entry look like? It's going to be a debit to my allowance account. So I'm going to debit my allowance account for whatever number that is. And I'm going to credit my accounts receivable account. Okay? So when I hear write-offs, I think someone's died or they've moved to the Bahamas, and I want to tell you why. So write-offs, we know for sure that people won't pay us the money. And the way we know that is I want you to imagine if we work in a company, there's a collections department downstairs that's been calling all the people who are way past due on their bills, and those people just haven't answered the phone. They've tried and they've tried, and finally that collections department calls us up in accounting and they say, hey, Jim, we tried to get a hold of him and he's just not answering. He's not going to pay us back. He owes us this amount of money, but he's just not going to pay us back. So he's either died or he's moved to the Bahamas. We just know for sure it's not going to happen. So I, as an accountant, say, okay, that's disappointing that we're not getting his money, but you know what, good thing I set aside some money in my allowance account, which I call my little piggy bank, right? So I want you to imagine your allowance account as a piggy bank. Forgive my drawing skills, but hopefully this helps. Okay, so my allowance account is this piggy bank. We take out of it every year when we write off accounts. Essentially is we know that people won't pay us back, so we say, hey, okay, we'll pull out of our piggy bank. This is kind of a savings that we set aside in case people don't pay us back. Okay? So if we're constantly pulling out of this piggy bank with write-offs, we're eventually going to run out of money, right? So at the end of every year, we need to add some money into our piggy bank. And the way we do that is with something called bad debt expense. Okay? So, I'm going to draw another little T account over here. I'm going to call it bad debt expense. Now, I don't want you to get this mixed up with my allowance account, because what statement is my bad debt expense on? Is it on my balance sheet or my income statement? Think about it for a second. Pause it if you need to. It's actually on your income statement. Okay? So this is a nominal count. It's going to go away next year. So anything that we need to record this year, we need to do it now. We can't wait until next year. So with your bad debt, when you're making credit sales to people, you know that some of those people won't pay you back. But if you wait until next year, you're going to show an expense in a year after when you've already recorded the revenues this last year when you made the credit sales. So the whole purpose of having this allowances account is when you set aside this money, you can record the bad debt expense, set it aside on your balance sheet, and then use it when people actually don't write off, or when they actually don't pay you back, when you have to write off an account. So this adjusting journal entry is one that you always hear about. These numbers will always be the same. This is adjusting. And this happens at the end of every year. So, as you can see, we are debiting our bad debt expense account for however much we calculate, and then we are crediting our allowance account because we're adding to it. Remember, it's a contra asset. So this adjusting journal entry happens at the end of every year. Now, how do you decide how much to set aside? Well, that's the big question, right? That's where the two methods come in, and we're going to talk about that in just a second. Just understand that you're setting aside money and recording the bad debt expense so that those expenses occur in the same year as the revenues, right? So let's now talk about how we figure out this number, and that's where the two methods come in, okay? So, I'm going to erase part of this. Let's talk about how we decide how much to put into our piggy bank. And there's two methods. So the first method is percent of credit sales. Okay? And people call this the easier method because it's just one less step. Okay? So all you do, I want you to think about, these are the two T accounts that you typically would see, right? And you're going to have credit sales right here, because that's where you always put it. You always increase accounts receivable with credit sales, right? With the percent of credit sales, they take a percentage and they say, you know what, of all the people who said they're going to pay us back later, this is how many we think won't pay us back next year. So we take that percentage that they give us and we multiply it by our credit sales. And that number that we get, once we calculate, comes up over here and becomes our bad debt expense journal entry. Okay, one way to remember this, if you need help remembering and differentiating between the two, is that when I multiply by an above the line number, so when I take this percentage and multiply by a number that's above my total line, right here, it gives me an above the line number over here, right? It doesn't give me my total, it just gives me my number. And then my journal entry is still the same as we talked about before, bad debt expense and credit to allowance for whatever number we calculate. Okay, second method is percent of ending AR, or also known as aging. Aging is just an expansion of the same idea. So let's talk about this one. So you have your accounts receivable account, you have your allowance account, and only in this method they say, okay, we're not going to do with all the people we make credit sales to, we're going to do with all the people that still owe us money. And we think that there's a percentage of those people that aren't going to pay us back. So essentially what we're saying is, of all the people that owe us money, this is how much we think won't pay us back. And when we multiply there, it gives us our ending number. Now this is the number one mistake students will make, is that they'll take this percentage, make it their ending, multiply by their ending, and then they'll plug it in and think, oh, that's my adjusting journal entry. No, there's one more step, and that's why people perceive this as harder, because it's just one more step, right? So there's going to obviously be a beginning balance, there's going to be some write-offs. So after you calculate this ending number by doing this, you just have to solve for your bad debt adjusting journal entry. So that number, again, just like our adjusting journal entry before, we will debit bad debt expense and credit your allowance for that solved number. Okay? Alright, so now let's expand on this idea. Okay? So for aging, it's the same exact idea, only instead of taking one percentage by one number here, they expand it and they say, okay, if there's $200 that people owe us, they split it up into different buckets. They say, okay, there's $100 that are less than 30 days. There's, say, $50 in the 30 to 60 category. And there's, say, $25 in the 60 to 90 category. And greater than 90 category, there's $25. So if you notice here, these numbers right here add up to my 200. All they did is take that 200 and put it in different buckets, okay? So then they do this because they can be a little more accurate. Because do you think these guys are more willing to pay or these guys are more likely to pay? Now stop and think about it. Do you think these guys are more likely to pay or these guys? Alright, these guys are going to be more likely to pay because they're less past due. These guys are already past 90 days, so it's less likely that they're going to end up paying. So they're typically going to see higher percentages down here and lower percentages. So we can assume maybe only 1% of these guys won't pay and maybe 10%. And I'm going to just use easy percentages. So, and these percentages will always be given to you, okay? So you won't need to make them up, but I just want to help you understand why they're doing this, right? So in this earlier method, we took one percentage by one number. We're just doing multiple percentages by multiple numbers. So you'd get 1 here, and 5 here, and 12.5 here, and 12.5 here. Now pause it and think, what would you do with all those numbers? You have all these numbers, what are you going to do with them? You're going to add them up, right? When you add them up, you get 31. Now pause it for sure and think, where are you going to put this 31? Are you going to put it up as your ending balance, or is it going to be your bad debt expense adjusting journal entry? It becomes your ending balance, and you still have to solve. So this is where the big mistake happens, because people think, oh, I've already done all this math, I've already got the answer, that's it, and they plug it in and they say, oh, 31 is my adjusting journal entry, but that's not the case. You have to do one more step and solve. So please don't make that mistake. We don't want you to make that mistake. So that's it. Those are the two methods. As you have more questions, please feel free to come in the lab. We're happy to help you, and we want to be there to help you conquer this test.